Partner and National Leader, Ernst & Young India, to deliver the keynote address. Ladies and gentlemen, kindly put your hands together for Mr. Diwanji.
Thank you, ladies and gentlemen. It indeed is a pleasure to be here in front of all you bankers, ARC people, alternate asset providers, and everybody else. And I'm glad that asset reconstruction and NPA is actually being considered as remodeling. Frankly, it needs a lot of remodeling as we go along. As I deliver and as I saw the agenda for today's session, we have a set of alternate capital providers who come in first. Then we have the ARCs, and then we discuss exactly with the bankers around how asset reconstruction can be done. Now, just the two bits. I have been associated with asset reconstruction for the last 2 to 3 years, and we have been dealing with a lot of companies having on-ground experience. Just a few things for this conference today to deliberate on. What is the cause of NPAs in our system? And I'd like to kind of spend 5 minutes on the causes of NPA. Our system was no different until 2007. The world grew, India grew, we were all very happy. 2007, when Lehman Brothers happened, the world fell apart. But India thought that we were a decoupled economy. We were not linked with the rest of the world. Hence, our asset creation grew. Our loans to the banking system, the loan growth in the banking system, was 26% in the year 2007, 2008. 18% or 19%, I think, in the year 2009. Despite the world degrowing, our economy grew at 7%. Our businessmen were easily getting money. Why? Because the banking system was pressurized to grow at 26%. Because one bank grew, the other bank had to grow. And I know for a fact, if you talk to promoters today, there were a queue of bankers outside everybody. 2007, 2008, when the world was falling apart, offering money. Great. What did the promoters do? Bought real estate. Invested heavily in capacities. Said that let's do the carry trade because internationally rates have crashed. Why don't we try and make some money out of borrowing dollar, borrowing yen? Because the Indian rupee is strong, Indian economy is growing, is decoupled. Indian exchange rate will remain stable, everything else is falling, let's take advantage of that. That's what they did. Then they said, there's so many assets going a-begging. Why don't we go and buy some of these assets? Because we have the ability to turn it around. We have the strong financial position. We have a strong domestic market. Let's go venture into international markets. That's when people started buying plants in South America. People started buying plants in US, in Europe. But what we did not realize is that we were a coupled economy. And frankly, come 2010 or 2011, we realized that we were not. And we were facing the stress. Our economy started facing stresses. Our carry trade started going the other way. People may remember WOCAD. Our carry trade started going the other way. The international operations which we expected we could turn around, we could not because we were no different than any other promoter in Europe or any other company in Europe or US. So those operations effectively had a problem. And domestically, we had a policy paralysis of sorts. So our coal mines went away, our 2G licenses had an issue, everything else had an issue. So effectively the stress built onto the system. Credit growth, by the way, was still at 12, 13, 14%. It was not bad. But the incremental credit growth was going effectively towards servicing interest cost. We had a good 4 or 5 years, in my opinion, where the incremental credit growth, if one were to analyze it, went to pay interest. We had CDR mechanism in place. We had various other mechanisms, restructurings with the provisioning norms that had relaxations. We could do restructurings. We did them. We funded more interest. We made grandiose plans that India will continue to grow. In hindsight, 2020, these are the issues. So really we built on, and today if you look at the total outstanding, in my opinion, I don't have the numbers, but in my opinion, easily 20 to 30%, or even more, maybe 30, 35% of the total outstanding today is nothing but funded for interest. So we have that component sitting in our balance sheet. This is really where the articulation of the problem is. So today, we have a situation where in 2016 or 15, the RBI did an AQR, the problem came to surface, and we had bad debts which rose significantly. Today we are at 9.x% gross NPA. And that is in a way a real situation as of today. But if you look at RBI's own projections, 2018, gross NPA is expected to be 12%. So congratulations, it's a growing market. But the issue is that there needs to be active resolution. And I mean resolution, which is required. And the credit, which earlier went for interest, ought to go for active resolution. So what RBI has done in the interim to resolve some of this, they came up with good amount of schemes. So first of all, they said CDR is disbanded. And not disbanded, the provisioning advantage to CDR has been disbanded. People can still do CDR if they wish to. Then they said that we will introduce newer schemes. So a change of control scheme was introduced called SDR. So SDR effectively said that get a new promoter, we will do any kind of restructuring you wish, make sure the loans are paid. Yet nobody was willing to write off loans. We will restructure those loans, come a new creditor. Maybe a little bit of discount we will give. That process went on for some time. We did not have too many bidders. I've yet to see one full 100% successful SDR. There's one happening right now in the south. But that's about the only one that's really happened. Then they came up with another scheme as a rejoinder to say, fine, if there are not going to be enough promoters, let's have another scheme which talks about retaining the promoters as long as the sustainable debt is of a particular size. So the definition was 50%. If 50% of your debt is sustainable, we will keep the promoter intact. The balance 50% we shall deep restructure, and you go on. That was another scheme. That was a little more successful than the SDR scheme, for the simple reason that the promoter was not dislodged. But the disadvantage of that scheme was that very few people actually fitted into that. Given the fact that we already had a bloated loan position, given the interest accruals being added onto loans, we had undercapacities because of the consistent pressure that corporates formed. So corporates were operating at 30-40% capacity. So a combination of a 40% capacity plus a 30-35%, 40% inflated loan position because of interest, the 50% threshold was very difficult to meet. So frankly, there also we until now had only one case which has been successful. And another one case recently got withdrawn. So the one which is successful is HCC, it's in the papers. A good one. Got successful for different reasons, different than just an S4A, just by the way. But whatever. So the S4A scheme was there. Then we have obviously introduced the insolvency code, which I think was a much needed one. The insolvency code came with a few principles. The key principle there is failure is acceptable. Now that has to be deliberated in the Indian system. Because in the Indian system, until now, or even today rather, failure is not acceptable. A business failure is simply not acceptable. Because the first thing that the banks want to do is a forensic review and try and nail somebody down. Nailing anybody down never revives a business. Even the code, there is enough misconception today that the insolvency in the bankruptcy code is all about liquidation. It is not. If you look at the iterative process under the code, the very first thing it talks about is revival. It talks about provision of capital. It also talks about building about stability. That's why the insolvency professional exists, because he would not think hockey stick like a promoter, but he may think stability first. He may moderate expectations. He may be able to use available finances much better than what a promoter would do. He would be much more dispassionate. That's the expectation. So it's about revival, stability and revival first. And if that option is not acceptable, then liquidation. That has to be very clear to everybody. And that's where the role of alternate capital providers, asset reconstructors comes in. Now, having said these things about the economy, let me also tell you a few positives. The reality is, India is still expected to grow at around 7%, which is not bad. India still has capacities which are needed but are not yet ready for use. India still has a need for incremental capital to sweat those capacities. And frankly, if this gathering here debates and deliberates on how those capacities can be sweated, That's where the opportunity for revival is. And that is the much better opportunity for revival than any liquidation. And today India is at the threshold. It is the largest growing economy in the world. Why would there not be opportunity? Now talk about our sectors. Steel. Despite the cyclical issues in steel, if there is strong long-term capital available, steel can be revived. But there is capital required to get the plants up and running. We face a turmoil, right? There's coal allocations which got cancelled. There are iron ore allocations which got cancelled. It disrupted the industry, apart from the fact of the macroeconomic issues. But domestic demand has been sustained with the minimum pricing. Frankly, there is scope. Take EPC. EPC was one of the companies which got impacted when people took very aggressive EPC contracts because money was easily available from banks. But is that government spending? Look at the current budget, 2.4 lakh crores in government spending. Will that not result in EPC work? Of course they will be. But will the EPC guys need capital? 100% they will, because today they don't have it. And in EPC business, unless you provide working capital, unless you provide bank guarantees, unless you provide hardcore money to grow some of those assets and remove them from the stalled situation, there will be revival. The biggest issue in EPC is claims. Because everything does not go to plan and there are claims. And government does not pay those claims effectively for a very long time. Those result in working capital cycles being longer. And if working capital cycles are going to be longer, somebody needs to fund them. I mean, today an HCC asset became a success because the government decided to convert the loans into guarantees and release the cash back. That's how the working capital cycle has shrunk, by converting of a funded facility into a non-funded facility. That's all that's done. But that has brought down the cost and that's provided liquidity. Similarly, somebody needs to provide liquidity. If India has to grow, 2.5 lakh crores has to be deployed by the government, and I think credit growth will be government-led first and then industry-led over a period of time. But that is the requirement going forward. So EPC will revive that way. So there is opportunity for EPC because of government spending. There is revival of core industries like steel and cement. Cement is anyway revived in a way, but cement is one of the good assets that people end up selling to reduce their debt burdens. Real estate is another one. And with increasing real estate advantages, with shops coming in and low-cost housing, etc., there is a significant need, because there is a latent need. There is housing required in the Indian system. So there is demand. Now, coming to the bank side, which is a real problem, which is again a point of deliberation. Do banks have the ability to right-size debt? Did a small analysis. If you look at it, gross NPA today in the system is 9%. I'm talking about today, September 16 numbers is what I'm saying today. 9%. Net NPA is 3%. So we have a 66% provision on NPA. NPA declared is around 6 lakh crores. So on 6 lakh crores, roughly, we have a 66% provision. Estimated stressed assets in the system, if you were simply to include the restructured assets, is roughly 9 lakh crores. Could be anywhere between 9 and 10 lakh, take a guess. Say 9 lakh crores, let's take the restructured number as per the government. On that, there is certainly a 15% provision minimum. So that's a requirement. So if you take 15% on 3 lakhs crores and 66% on 6 lakhs crores, your weighted average provisioning is roughly 50%. So banking system today does not need capital to the extent of providing for 50% of its assets, 50. With budgetary allocations and with some kind of capital rationalizations, including the tier 1 bonds that they do, I think there will be an ability to go to 60-65%, which is a pretty good number, frankly. Of course, the big challenge is, given the recent developments, will banks actually convert provisionings into write-offs? Question. But I think they will do it. I think the positive part is that with things like the IBC coming, where the decision making becomes more transparent, becomes more covered, with the legal system also looking at it, I personally believe banks are headed towards resolutions and converting those provisions into write-offs or some kind of preference shares or some kind of obligation which is inferior to debt. And if they end up doing that, frankly, there is a big opportunity that stares us in the face. For the alternate capital providers, who, and I would include private equity guys in that, they've historically taken minority stakes, come into businesses, had bought positions, and generally been passive. This is their opportunity to come in, take majority stakes, because frankly, almost every promoter now is very happy with a significant minority because they want to save their businesses first. So you come into that position, invest your money in, retain what I call as the promoter's pride, because if you give that away, if you treat him badly, there's going to be retaliation. But if you treat him well and he knows his limitations, I think you're there. Also, if you give him a little bit of an upside to basically get some benefit of helping you turn around that business, that will be an additional help. So if you look at it, there is a conciliatory approach along with the existing promoters to smoothly transition a business. There is control available. There is higher stake available, and that is true private equity. I personally think even things like ARCs, and you can debate it. The last point I'd like to make, frankly, before I go off, is until now, resolution was very accounting driven, and I'll define what I mean by accounting driven. The biggest consideration was what kind of provision do I need to take? Do I turn into an NPA? ARCs will be redundant because, after 1st April, the provisioning norms are similar whether you sell to an ARC or don't sell. How does it matter? Because provisions are already made. You still have an option to go through an ARC or not go through an ARC. What it says, for at least from 17 to 18, the rule says that of a transaction, 50% should be cash, 50% should be ARC. As long as 50% is ARC, I will allow you to recognize that as a true sale. If not, please provide as if the loan was never given. That's what it says. RBI is only having provisioning norms to protect the resilience of Indian balance sheets. Why would we want that to impact resolution strategies? And with a 50% cover going on to a 60% cover, we should be less bothered about it. And the minute we are less bothered about it, we will focus more on resolution and less on accounting. And that is where our answers will come out. So with that note, I think there is a lot of opportunity in the industry. As we look at it, it's 9 lakh crores worth of booty available to revive. And I would wish the seminar all the best in terms of discussing how best to do it. Thank you.
Thank you, Mr. Diwanji, for your keynote address and for setting the tone for this summit and the proceedings to follow. I request Ms. Archana Tiwari Naidu, Content Head, ETH, to present a memento to Mr. Abizer Diwanji as a token of our appreciation.